Lizanne Sonders. And Lizanne, you point to something that was written up pretty well this week, and that was hours worked getting cut, and maybe a tell about what the back half of the year could bring us in the way of payrolls, right?
Yeah, so the June report did have a slight uptick in hours worked, but that has been in a big downtrend, and it's in keeping with the narrative around labor hoarding, and also tied into that is the fact that nominal revenue growth has been so strong. Real revenue growth is nil. It's in negative territory, but nominal revenue growth has been strong, and that's been a support for the labor market and for companies. That's why I think second quarter earnings season, we know earnings are always important, beat rate, all of those metrics, but I think the analysis on revenues, unit sales, what that means for profit margins, and the cost of labor as a component of that, I think those messages are going to be equally important as it ties into the macro environment versus just the earnings stories.
Do you think right now, I mean, airlines, actually Pepsi too, may be great examples where input costs have provided a lot of relief. It's not necessarily getting passed through, and that's a margin story at a time where we're kind of wringing our hands about earnings. You feel good about that from a corporate perspective?
So I think we're in the midst of this margin story, and depending on what version of margins you look at, whether you look at it just for the S&P or a broader measure of companies, you're down 2 to 3 percentage points from what was profit margin highs last year, in some cases all-time highs, and that is a bit under pressure. And now we've got, again, the revenue side in real terms in negative territory, nominal revenues coming down. It's sort of the other side of this inflation story, which has been a negative broadly, certainly in terms of Fed policy. I think the impact on things like consumer sentiment, but it's been a positive for many companies, certainly via the labor market channel. So now that that's coming down, there may be more attention on the potential negative side. It's sort of like, equities live in a nominal world and bonds live in a real world. And I think that distinction may be coming into clearer focus in this environment now of negative real revenues.
Lizanne, are you still sector neutral or sort of ambivalent? Because, I'm looking at the performance year to date. Technology and communication services sectors are up 40% plus. Healthcare is down for the year. Financials are flat. It has mattered. What sector you're in.
Yeah, but you can also get to performance biases via factors, not just sectors. I think monolithic sector decisions doesn't help you as much as focusing on factors. And a lot of the factors we've been emphasizing, like strong free cash flow, healthy balance sheet with ample cash and low debt, positive earnings revisions, positive earnings surprises, a lot of those names that have powered the market higher in areas like the growth trio of tech communication services and consumer discretionary, you get exposure there, but you're doing it through a factor screening approach versus trying to make a monolithic either sector approach or a broader, say, growth value index style approach.